You're watching Business Edge and getting into the first conversation of the day. In the midst of challenging economic climate, Nigerian banks are grappling with a significant increase in bad loans, which have soared to a staggering 478 billion naira. The Central Bank of Nigeria responded to this mounting issue in 2020 by releasing the Global Standing Instruction Guidelines on one hand to closely monitor persistent loan defaulters and ensure funds recovery. On the other hand is the Asset Management Corporation of Nigeria, which was established in 2010 for the primary purpose of efficiently resolving the problems associated with non-performing loan assets of Nigerian banks. With these measures, questions have been raised about which of these is the most appropriate in relieving financial institutions of burdens due to bad loans. This morning, joining me to talk more about this is Gospel Obele, Chief Economist, Streetnomics. Thank you so much, Gospel, for joining us. Gospel, you need to unmute your device. We can't hear you yet.
Hi, Lekan. Good morning. Thank you for having me.
All right. Now, 478 billion naira is a lot of money for non-performing loans. And that was even during the first half of this year. And some have blamed this on government policies resulting in harsh economic conditions, hiking interest rates, and in some climes, failed investments. So what's your take on this?
Yes, these are very valid perspectives. And I agree that it's quite worrisome having that huge chunk as non-performing loans. However, this story has been building for quite a while now. Knowing how the economy has, evolved in the last 10 years, safe to say, or 6 to 7 years, lots of events have happened. Lots of narratives have been built into recovery, sort of like an economic rebound, and helping businesses, thrive through the series of crises we've come out from recently. Now, within the context of these different movements, is the fact that you have constant leakages in the economy and that you have structures of loan financing and all that are not necessarily very healthy for the economy. You have situations where, in fact, in the past, situations where banks had to go bankrupt because there was heavy capital finance loans, in sectors that would take them long term to pay back. So when you finance a project that it would, definitely take a long term to find your ROI technically, that would mean that in times of economic downturn, you may need more finance to keep that project alive. So these are the many arguments, again, due to the fact that who accesses loans for what reasons at a particular period of time is also relative, from bank to bank, relative from looking at it from different perspective of life to a large extent. So there are many underlying factors that shaping the growth of NPLs, and many institutions are really not safe or in a good position, as it were. So yes, I said all that to say this, that issue or that challenge has been there, for about a decade now. The economic crisis we faced in the last 1 year only deepened or worsened what's already been there. And we've also found out that, it sort of placed a lot of banks at the edge, especially the tier one banks.
So in as much as it is a standard procedural task, we now see that in reaction, banks in Nigeria have started writing off non-performing loans to reduce the volume. But then of what importance is that move when it doesn't necessarily mean that these debtors wouldn't eventually pay what they owe?
I mean, to be honest, we're in tough times, and you want to also factor in the impact of inflation on these loans. You want to factor in the impact of, in fact, how these loans were even given out in the first place. So there are lots of the different parts of this conversation that are not made to the public that are very, very internal amongst the institutions that have exchanged loans, right? So you also have the rising cost of living, cost of doing business. Lots of businesses are no longer sustainable. Even large businesses, lots of manufacturing projects are no longer sustainable. Lots of capital incentive projects that have swarmed up loan financing in time past over the period of time have not been sustainable. And, if you recall one time about 2 years ago, there was arguments to sort of restructure loans in Nigeria, looking at COVID-19 and how all of that may have impacted many moving parts of doing business in Nigeria. So there was a clamor to restructure loans, and banks went on a spree to sort of begin to restructure and all of that. So now you have inflation hitting high interest rates again. That's to tell you that loads and loads of individuals or institutions who have lent money are discouraged to pay back, or there's a higher cost of paying back vis-a-vis the amount of loan or initial interest rates that they had taken those loans on. So there are very lots of moving parts in this argument. And I know that, I mean, part of the argument is for banks to sort of relieve these institutions on the amount they have to pay back. Again, it's not so sustainable because the ideal culture of who gets what loan and why, in what sector, for what reason, is a major part of the current monetary system that's sort of incentivizing the rising NPLs we find today.
Let's now look at the GSI. The CBN in 2020, according to reports, released the global standing instruction guideline to address issues of non-performing loans. So what's your assessment of the level of compliance to those laid down rules in Nigeria's financial sector?
The GSI was released, I mean, technically took effect from 2020 at the heart of the pandemic. And looking at all the events that happened between then and now, you would want to ask yourself, is there a need for a review? Is there a need for, trying to sort of contextualize the different exemptions and the state of those principles and what's expected from other institutions? So, I mean, safe to say that it's been sort of like a fair compliance. The central bank and many of its affiliates have been very much involved in firefighting of engagement. So I'm not so sure there's been a very heavyweight level of full-length compliance by the central and commercial banks and other loan-led institutions. Another sign to know is the rising nature of NPLs. Again, the rising nature of NPLs are largely built on incentives, human factors, systemic arguments that you really can't take out of the equation. But when you have a strong leakage economy, it amplifies, the growth of NPLs in that economy, regardless of if you have a policy or not. So it's safe to say that it's fair. It's fair because, I mean, most of these banks will have these policies on their loan desks with the credit officers and all that. But how many of these line items have been executed? So when you juxtapose that with the weight of leakages and the motives around loan financing, project financing, corporate loans in Nigeria, then you realize that the latter far outweighs the former.
According to the Central Bank of Nigeria, the GSI allows banks to recover the outstanding principal and interest upon default from any account, and that has to do or speaks to the modality by which the GSI helps or is being put in operation to recover bad loans. Now, looking at this, how would you describe the process, the operation? Because it will be very instrumental and important that we understand how the process is done, because there have been questions about a breach of privacy when we have a standing rule whereby these Nigerian banks would have to do as much as they can to recover their loans across all banks. Probably there will be some sort of synergy across all banks in Nigeria, but then there's the issue of a breach of privacy. So how do we now ensure that these loans are recovered without having to intrude on people's private details or confidential information?
To be very honest with you, it's a counterproductive scenario because you have a standard policy that has been developed to help us recover at least the capital and probably some level of interest on that loan. Then you also have a situation where these loans are not driven by the book. I don't know if you get what I'm trying to say. So technically, it would mean that the current state of the monetary system may not be able to recover loans without getting to personal issues with the stakeholders. And then that's when you now begin to talk about other softer elements of trying to recover loans, extended negotiation tactics, lobbying, possible review of loan structures to have a plan to help people pay back over a period of time. So and that's where you have that, because it's not really cast in stone. All right. So ideally, you should be able to get these loans back from individuals, at least the capital amount or some basic interest amount, without having to go into private issues or deal with them privately. But because of how this narrative has been structured so far in Nigeria, there's a very much likelihood that the current institution will go private. Another angle to think about is the fact that when you compare the rate at which the pace at which interest rates are constantly on the rise, it further negates the ability and the capacity for individuals or institutions that access loans to pay back. All right, so that's again still counterproductive to what the policy says, And if you're going to be able to recoup capital and also recoup the interest value on that capital, then it's almost impossible not to go personal, taking into cognizance that the cost of borrowing or the interest income is way higher, but also a higher interest expense for the borrower. So it's very difficult for financial institutions not to go personal with the current state of things. However, personal can also mean that you go into a healthy dialogue with institutions who are with creditors, with debtors rather, and then you find a way to sort of get people to pay back, create incentives to also encourage them to pay back, and then have a clear possible timeline to secure all the capital funding and as much as possible interest that maybe a fixed interest payment system or something like that. So the response to the question is quite hard to detach the personal dynamics from the current state of the scenario in terms of how the policy works and how the loan dissemination system really works in Nigeria.
So what about the Assets Management Corporation of Nigeria, AMCON, that was actually established in 2010 to efficiently resolve the problems associated with non-performing loan assets? Now, we have a 478 billion naira being lost by Nigeria's financial institutions. Would you say that it has addressed the issues of bad loans incurred by the banks? Because obviously, it doesn't seem that way.
Yeah, so again, very similar to what's happened in the case of GSI. The AMCOM has really, led lots of efforts to recover loans. But it looks as though the more you would put in some more effort, the worse the situation becomes, and that's because the fundamental arguments as to how loans are given out, where they go to, and how those monies are being used are largely off the books. I don't know if you get what I'm trying to say. They're not even in line with what's expected. All right. So take for instance now, you take an XYZ billion naira worth of loan to build a manufacturing plant in one sector that is really plagued with so much economic disadvantages, just in a bit to say you want to solve one major economic problem or the other. When you go on that elephant-based project, you realize that there is no continuity. You realize that the project may not yield much. You realize that there was even no feasibility study done before that project was done. All right. So you have cases where loans are being given out on the grounds of no feasibility study, no clear investment case, no clear pathway to pay back. You don't even know what the clear returns on those investments are. These deals are being done in very huge numbers in many institutions in Nigeria. And even safe to say in many places in the world. All right. And because of that dark economy way of doing things, there is a limitation. AMCON itself is limited as to what it can track and other. However, on another level of engaging intelligence, these things are very possible. All right. So, but that's a different conversation for another day. So it's now very likely a function of how much or how well can these institutions, these recovery institutions like AMCOM, use data and intelligence to sort of track, engage, and even if possible need to negotiate with institutions to ensure that they're recovering as much as possible. The tactics over time as well has been some form of forceful way of recovering, not finding a middle ground with stakeholders, because times are not difficult, coupled with the fact that you have a really weak and poorly judgmental system as to how individuals access what, where, and why, and how.
Now, you've actually highlighted some lapses in conducting risk assessments, visibility studies to know what kind of business or capital investments that can be given to probably individual or businesses. And we see that that is a major challenge for Nigeria's financial institutions. But then we have a GSI which gives banks powers to recover funds from debtors across all financial institutions. And we also have AMCON, when invoked, seeks to provide financial cushioning to banks while also recovering debts from defaulters. So do they actually work together, or probably one is an extension of the other, or they actually work as separate entities to try to achieve a particular aim, but then are not really meeting the mark?
Yes, the top of mind expectation is that they should work together. However, some of their functions also conflict, as the case may be. And I also think that the central bank is limited in context to even engaging and overseeing and sort of supporting the work of AMCON currently does. So you also have the apex institution, who is the originator of GSI, dealing with the portfolio of jurisdiction it's well aware of. and has control over. Again, that's a limitation. All right. So the big ticket question will be, how can this transition, clearly they're not collaborating enough, for us to have this kind of problem right now. Number one, they're not collaborating enough. Number two, if they are collaborating enough, they're probably not dealing with the right issues at the root causal level. So even if you come back to help banks who are, losing that capital base and all of that, and you're also trying to, recover old loans and all that, you also need to take into cognizance what are the root causal effects that has led to this rising NPLs in the first place. Why is it that, it's just like the debt situation in Nigeria, with what Dr. Kondiwela did in 2003/2004, Nigeria is, in a very worse off situation, almost 10x than where we were then. And also thinking of the fact that we are even dealing with weaker currency right now. All right. So would you say that she didn't do her best, or she probably didn't work with the right institutions to get things done? No, it's likely a cultural problem to find out that what you need to fix, went wrong again because you did not fix at the right root causal, stage of what leads to the problem in the first place. So my argument will be for the institutions to probably collaborate more and deal with these issues from a collaborative level at a root causal stage. Trying to find out the cultural, more importantly, the cultural and behavioral dynamics of how loans are being awarded, which projects, which sectors they go to. Probably even restrict loan lending to some key sectors in Nigeria. Yes, I understand some sectors need investment to come alive, but until the level of risk assessment, until the level of feasibility is done, and the numbers are fairly in check, it can't be perfectly in check because Nigeria is still a very volatile economy. All right. So there has to be a lot of moving parts built on intelligence to put a track and collaborative effort to ensure that, there's an end to this thing. However, I don't really see an end to it because the dynamics of this loan financing thing in Nigeria is really deeper than what we think. They are more cultural and traditional / behavioral elements than they are institutional.
Okay, let me quickly share with you these particular statistics and get your response as regards the health of Nigeria's financial institutions, because, of course, they are the receiving end. Now, in the report released by the CBN recently, the capital adequacy ratio and liquidity ratio remained above the minimum threshold. Now, the capital adequacy ratio, it decreased about 11.2% in 2023 from 14.1%, but then they said it's remained above the 10.0% prudential requirement. Then the liquidity ratio was also above 30.0% regulatory minimum ratio, increasing from 42.6% to 48.4%. So looking at these statistics, does this suggest that Nigerian banks are still safe, or rather edging towards a precipice?
So let me ask you a question in response to that, and I'll answer the question. When you say unemployment is 4.1%, do you really think that you have, more people in Nigerian youths who are employed? So the answer is no. All right. So yeah, we're good with using numbers for the sake of, to a large extent, being medially or politically correct, but it doesn't in any way equate, that these banks or financial institutions are healthy. All right. And many financial institutions are really struggling on the grounds of rising NPLs. And management level staff and all that are making really bad decisions on a day-to-day basis. The Nigerian financial sector is really unhealthy and to a very large extent worsening in terms of the level of waste and poor decisions that are being made every day. Also, do not forget that what's the quality of the capital base of Nigerian banks now in context to a failing currency? I didn't forget what I'm trying to say. So what's the value of the capital base in context to a failing currency? So if your CAR is above 10%, what's the value of that 10% in the first place to keep these banks in check when when the rainy day comes? So if you think about from the value of the currency, think about it from other economics and cultural dynamics, that through which financial managers make their decisions in Nigeria, then it's safe to say that those are just numbers that are almost irrelevant, to the context of the real-time state of things. All right. If Nigerian banks do not, take severe action and all of that, you'll find a situation where so many banks will be bankrupt, in the coming years, and you will not be surprised to do it because, I technically could tell that lots of reworking of numbers and ensuring that banks are looking good outside is really being done at the moment. So many Nigerian banks are not healthy. Many Nigerian financial institutions are not healthy as well. So it's time for us to leave this argument of what the threshold is or what is not. You find that same argument in the Commission of Debt, debt servicing and all that. Debt to GDP ratio. Oh, we are still low, so we can still take some more money, right? So it's those arguments you find out when institutions want to be politically correct or medially correct or want to confuse people who do not understand the real time impact of what's going on.
And that just means that living in denial will not actually help any of these financial institutions. Of course, Nigeria's financial ecosystem, when we have facts and issues that need to be dealt with, but then we are looking the other way. And that's very important because, of course, when you have an economy and a system that is getting weak every day, then probably might just portend something grave consequently in the later future. And that is what we need to look into. Gospel Obele, Chief Economist at Streetnomics, thank you so much for talking to us.
Thank you for having me today, Lekan. Have a wonderful week ahead.
And you too. It is evidence that decisive actions are required to tackle the significant challenges posed by the mountain bad loans in Nigeria, be it by adhering to the global standing instructions or the employ of AMCON. What is crucial is safeguarding the long-term health and stability of Nigeria's financial system and the economy. A short break we'll do here. We'll be back with more on Business Edge. Do stay with us.